right, so hello everyone, and first of all, this is my chance to thank you all for joining us in this evening for a special webinar directed to traders in the US equity markets. And I really do think that there is no single trader in the world that can afford himself missing what we are about to show you today. Trading in the markets, and I'm sure this is not a new thing to you, is the only business activity in existence today that can offer you controlling your life, fulfillment of your boldest dreams, controlling your precious time, and the ability to be your own boss. And for those who are here with us today for the first time, my name is Shlomo Cooper. I'm a professional day trader in the US stock exchange for the last 12 years and the head analyst of TradeNet. What I'd like to do with you today is to share with you one of the most secretive technique in Wall Street. This is a technique that, a very special technique that professional traders are trained to do each and every day during the earnings season. Let me promise you that you haven't seen anything close to what I'm going to show you today. This is literally going to knock you down, so hopefully you are sitting tight in your chair. So the earnings season for the fourth quarter is about to kick into full gear this week, and there are few things that move a stock faster up or down than an earnings announcement. Each day from now and through the following 5 weeks, we are going to see stocks that are jumping by dozens of percents to the sky or maybe plunging with big noise to the ground. There is lots of potential for taking big movements in stocks for long and for short for anyone here. Companies that disappoint in this earnings season will be crushed. This will lead to devastating losses for those unfortunate shareholders. And the hedge funds managers are just waiting for these individual weeks of the earnings season in order to make big money. And as you are going to see later on in this webinar, when I say big money, I mean it, big money. This is the reason why you are going to find the hedge funds trading in the commodities markets, in the oil market, in volatile stocks, and actually in all the dangerous financial instruments that can give them a significant movement and lots of money. That this is one thing they are looking for, big movements. The other thing they are looking for is liquidity, because if we have a financial instrument, a stock, a commodity, a pair, but the hedge fund cannot get into it with the amount they want, and they can't get out, they can't get out of a stock or a commodity when they want, we haven't done anything. The earnings season is providing a wet dream for the hedge funds. Big and sharp movements in stocks with a lot of liquidity that usually gets to hundreds of millions of dollars in the stock that had posted its earnings. So we actually looked yesterday and we traded yesterday DataLink, DTLK. It was a very nice movement, and as we can see, here we see on the daily chart the daily bar of DTLK. DTLK surged yesterday by 30% in one day, or we remember Apol, APOL, that after it posted its earnings a week ago, it skyrocketed by 15%. And we also have stocks that, of course, are crushing with big noise, like BBBY, BBBY, Bed Bath and Beyond. And here we can see an awful red bar to the downside. It actually was on the 9th of January, last week when the BBBY lost 17% on one day. This was its earning day. So obviously there is a lot of potential if you know what side to take ahead of time. But wait for a minute, mister, you may ask. Haven't we been told that we are not touching the stocks that are posting the earnings? Isn't there any taboo that says it is forbidden to go to sleep with stocks that are going to publish their earnings the following day? So if this is your position,
Holy cow!
if this is your position, you are quite right. Without the right tool, without the knowledge. All right, Meir is here just to tell us something about Herbalife. I believe. All right. So Meir, go
Yeah, I
ahead.
just sounded the $2 mark for the Herbalife trade. And it's almost 2.5. We have a system here in the room. We have different sounds for different targets. So AJLF just did more than $2 now.
All
That's
right.
it. Continue.
Right, Meir. If this is the time to show off, so I just want to put a trade I took today, SRPT, and if we can just look on that for a minute. Oh, this was amazing. Amazing. Actually, this is still amazing. I'm still holding a quarter of that. And just look on the daily chart. It went into a big gap. It left during November. And actually, as you can see, we took it above 2350. It was this thing. I think I still traded 1 minute chart. So if we take a deeper look on 1 minute chart, all right, we had here a nice cap, all right, a nice cap formation. So we took it above 2350 with only 20 cents stop, and back to 5 minutes chart. You can see all of the movement. Right now it's at 26.74. 26.74. That means more than $3 in the money. Yes, I've already I was able to take most of my position off the table, and it's a big gain. Right now, it's the best trade I had in this week, and I'm really happy. Hopefully, it's going to break 27 in a couple of minutes and making new highs. We will see later on. So back to back to our presentation today to the webinar. So um, we should ask ourselves, isn't there any taboo that says that it's forbidden to go to sleep with stocks that are going to publish their earnings? And for most of us, this is a rule. We are not trading stocks that are going to publish to publish the earnings. But and of course, without the right tool, without the proper knowledge, without the proper system, do not dare, and I repeat, do not dare to touch stocks ahead of earnings. These stocks may skyrocketing as well as crash. Now, yes, of course, nothing is better than waking up to a positive earnings surprise and big profits. It's nice if you catch the correct direction, but nothing worse than waking up to an earnings miss and heavy losses in your portfolio. A disaster. It's actually a disaster if you've been caught on the wrong side. So today we are going to push you one step forward to the courtyard of the big boys, and you are going to learn what the professional traders in Wall Street know to do during the earnings season, and how the earnings season is actually turning to be the biggest party of the traders 4 times a year, 5 weeks long, each party, each time. I'm going to reveal in front of your eyes one of the most protected secret in Wall Street during the earnings season. This method alone will give you the ability, the ability to each and every one of you to know exactly what stock you should enter ahead of the earnings, what direction, long or short, should you take, and how to take advantage of this huge potential for each and every one of you. This is a celebration for the traders. So before getting into the mix, I'd like to talk a little bit about the performance of the market as a whole when the earnings season is underway. Now, individual stocks can go from dogs to stars, and high-flying names can be whacked back to earth on any given release. For example, last week it was Alcoa. Let's get back to Alcoa on the chart. It's AA, Alcoa. Uh, until last September, actually, Alcoa was a member of the Dow Jones Index, and last week Alcoa kicked things off with an earnings miss. Actually, it delivered an EPS, earning per share, of 4 cents versus the 6 cents consensus, and it was the weakest stock in the S&P 500. As we can see, if we'll get to the daily chart, so this was the day Alcoa posted its earnings, and it went down over 7% in one day. So now in the last days, by the way, 4 days after that, as we can see, it has been able to fill the gap, but on the same day of earnings, it was all down, 7% down. With all the single stock volatility, the first question we want to ask is, how does the market as a whole react to earnings period? So we looked for you back over the earnings season history from the last 10 years to compare each earnings season with the off season. So let's have a definition. What is the earnings season, first of all, and what is the off season? Earnings season traditionally kicks off with Alcoa and ends about 5 weeks later with Walmart. So we defined the earnings season as the period between the report dates for these two names. The off season is the much larger part of the trading year that does not fall between those two dates. Since companies report quarterly, 4 times a year, there are 4 earnings seasons each year and 4 off seasons per year. So in front of us right now, we see on our slideshow, and I'll just take the laser so you'll be able to be with me. Hopefully you can see here right now my laser, the red dot. So in this chart, we are showing you the returns of investing in the S&P 500 only in the earnings season or only in the off season. We are dating it back to April 2004, as you can see. So the green line here, the green line is the off season period investment on the S&P 500, while below it we find the blue line. The blue line is the investment on the S&P 500 during the earnings season, dating back to January 2004, and this is an amazing stuff. The return for investing only during the off season, that means the green line, crushed earnings season returns by the off season gave us something like 68% versus less than 20% for the blue line for the earnings season. Now, let's gear up and talk about something. All right, Nick, is that understood what I mean by off season? Off season, the period between one earnings season to the other. All right, this is most of the year. Now, let's get up and talk about something much more important, and that is, how are you going to produce mega profits from the earnings season or from surprising earnings announcement in Wall Street? And here are 2 ways doing that. We are going to start talking about a couple of concepts in this first part of the webinar. We are going to make the second part of this webinar next Thursday, so make sure to be with us next Thursday. All right. First of all, I want to talk about the first method, and I am going to call the first method the good method. And the good method is the proper technique for swing trading. And it says like this, pay attention, buy every stock of a company that delivered surprising earnings and went up on the day of the news. I repeat, we should try to buy each stock of a company that handed out surprising earnings and also went up on the same day of the news. Because these stocks, guys, are going to show tendency to continue higher days and weeks after the announcement. Actually, studies are showing us that very, very clearly, they are showing us that these stocks are usually outperforming the rest of the market in the following 9 months. So we should buy, and in a short time we are going to see a couple of examples. We should buy every stock that delivered good earnings, good surprising earnings, and went up on the same day. On the opposite, on contrary, we should sell any stock that has missed on its earnings and is going down on the day after the news. I repeat, when we when the company is delivering the earnings, if it miss the earnings estimate and also the stock went down the same day, we should sell the stock. That means to get into short, because these stocks are usually showing underperforming the rest of the stocks in the market over the next couple of quarters. In this method, you are buying a day after the announcement should the stock meet our criteria. Let's see a couple of examples, and I'd like to start with Walmart. So I'm just typing here Walmart, just make sure we have enough time on the screen. And we do, and please scroll back with me to 17th of May, 2000 and 2012, right? Just so we'll be able to start WMT, not SMT, right? So I mistyped it. All right, and this is the daily chart of Walmart. Pay close attention. Right now, I'm pointing on the 17th of May 2012. This was the day that Walmart delivered its earnings, and it had a very, very good earnings. Actually, it exceeded the analyst's estimate. As we can see, the stock jumped up about 5% on the same day. We are not making any bet on the same day. We are waiting for the next day. So the day after that, we can see that there is a big volume. There is a spike both in the volume and in the chart. And this stock meets our criteria. Earnings surprise plus a big day on the day of the news. We are going to buy this stock. No, now I don't have any trigger. Actually, you can use the highest level of the earnings day as your trigger. So if the highest point here of the in the earnings day is 62.50, you may use it as a trigger, but you don't really need a trigger because this is going to be very, very precise. You just buy the stock and wait. And let's see what Walmart did from around $61, $62. The stock actually skyrocketed all of May, all of June, all of July, till it picked up in August. In August, it was worth already $74. So guys, here we see a journey of Walmart from $62 to $74. This is $12 of profit per share. If you take if you take 500 shares on this, that means around $7,500. This is a lot of money, and of course the hedge funds are going to do that with big amounts. And as you can do that, Walmart is a stock with a lot of liquidity. Millions of shares are exchanging hands each and every day. This is Walmart, and Walmart is the granny of Wall Street. Walmart is not is a very heavy stock. Walmart is not a sexy stock usually. Usually we are not day trading Walmart because it has too low range on a daily basis. But this is what Walmart did on an earnings surprise. Now let's go to a sexy stock like Facebook. So I'm going to go back on Facebook for last year, 25th of July 2013. Right now, I'm pointing on the bar of the 25th of July 2013. As we can see, Facebook is gap up, a big gap up. The stock actually jumped by over 20% on one day after it bottomed around June. But and it delivered very good earnings above the analysts' expectations. Now, we are not just buying Facebook on the same day. No, we are waiting for the session to end. The next day, when we are seeing in the rear mirror that Facebook actually closed the day on up note, we are going to buy it. So this is the day when I'm going to buy it. Now, if you want to have a trigger, again, exactly like the example on Walmart, just place a buy stop above the highest level of the first bar of Facebook. Here it's 34.88. So just place a buy order above 34.88. 2 days after that, you are going to be triggered, and from 34.88 the stock is just skyrocketing, coming up to $52 in 2 or 3 months. This is big gains for Facebook, a big chunk of gains, and this can be yours if you understand what to look and how to play it. Let's see the same exact behavior, but only on the opposite, only to the downside. So now I'm going to turn my screen to CREE, C-R-E-E, and we are going to go back on CREE to one of its earnings here, to its last earnings on August. This was the last earnings announcement on 14th of August 2013. And as we can see, after CREE made a new 52 highs, it plunged down by about 15%. All right, 15% to the downside. So from about 75%, it went down on the same day of the announcement. Very low, very poor announcement to $58. This was the movement. We are not part of the movement because in this technique, this is the first method I'm teaching you. This is a swing method. We are just waiting for the first big day to be finished, and after that we are going short on CREE. Now you can just take a short on CREE the next day at the opening. You can also use the lowest point of the day to be triggered. That means below 58.55. Just pay attention. Although we are making right now the webinar is taking place in a live market, and we are also trading here. We are trading here. This is the major role of this trading room. So Meir right now is telling us that he took a partial on Lulu. Well done, Meir, on Lulu. Right. All right. So this may be the lowest point of Lulu on this bar may serve as our trigger. It's being triggered, and from here to the lowest point of August, the stock actually, this movement actually makes us 15%, 15% to your trading count. That is very, very good. Now, if we take another example on Cree, let's take this gap down. All right, this gap down is taking place on the 23rd of October 2013. Actually, that was the last time Cree gapped down. It gapped down by about 10% due to poor earnings. We are waiting for the day to finish. This is a very, very big loss. The day after that, we are taking short on Cree. Again, you can just use the opening price to go short on Cree, or just wait for Cree to break down the lowest point it reached on the earnings day. That means around 59.20. So on the first option, you can take Cree. The following day. On the second option, when you waiting for the stock to break down the lowest point, it's going to be triggered about 2 weeks after that. It doesn't matter which way you are choosing. Cree is going down very, very sharply after that, and it's giving you back 13%. 13%, and that is a huge, huge movement. Last example before we are going to the second method I want to show you is to use the same all right. So all right, let's see another example on the same chart. I don't need to I don't need to flip a symbol. Let's use Cree and go to 23rd of January 2013. Actually, that was the first announcement on the earnings for 2014. 13, sorry, and this is the bar. So Cree actually crushed the analyst estimate. It topped analyst estimate, a very, very nice bar, a very big, a very sharp gain on the same day. All right, so we have both fundamentals figures. We have also data of trading that are very, very good. So the day after that, we are just using the opening to get into Cree for long, or using the highest level of Cree on the first day to get into it. I believe this concept is understood, and we are going to use it now that I shared it with you, and there are lots of opportunities for swing traders using this method. Now let's move to the great method, because as I told you, this is only the best method, but there is also the great method. So the great method tells us to search for stocks that the earnings engine, and I'll explain a little bit later what is the earnings engine, but the earnings engine is whispering you that they are going to jump, the earnings are going to jump, and you will be able to enjoy 10% rise, 15% rise, and even 20% gain when the earning announcement is finally delivered. I know what you think. There are no magic balls in the stock market. So how could that be possible? But no worries. This is not a magic show. This is a pure science. The idea is to find stocks that are going to surprise with their earnings ahead of the official announcement, has for long been the holy grail in the investment world in Wall Street. Big investors and even hedge funds have created specialization spotting these stocks. What I'm about to share with you is a winning strategy that no investor, no trader can allow himself to ignore it. If you are ready to collect the high potential profits of the earnings season and ready to jump into the water, this strategy is definitely for you. So first of all, what is TradeNet's earning engine? Just click on the documents right now. Right. just click on the documents, and I'm going to refer you to the earnings engine. This is a huge database. Right now it's on the chat, called TradeNet's fourth quarter earnings engine. You are more than welcome to click on this link, and you will be able to download a big database of data, and I'm going to screen it. I'm going to broadcast it on the screen. 1 minute. I need a big screen right now to show you what is this. And guys, you are going to absolutely love it if you are not familiar with that. And I bet most of you, if not all of you, are not familiar with that, but this is why you are with us right now. All right, so the screen, my screen is on your screen. This is the database. This is the engine. The earnings engine is actually a huge database that contains comprehensive fundamentals and statistical data. In a minute, I'll show you how this engine is actually looks like, and I'll show you also a couple of methods to make substantial gains out of it. So you'll be able to be literally one step ahead of the market. The earnings engine is, as you can see, in an Excel format, and as you will see, it includes the company's expected report time. All right, this is an American date, by the way. You can see also the time. Is it going to announce the earnings after the close of the market? This is PM, post market, or sorry, PM. Yeah, PM is after the market is closed, or AM. That means in the morning before the opening bell. All right. So before the opening bell, after the opening bell, PM after the opening bell, PM after the close. Sorry, after the close, AM before the start. Uh, as we can see, we can have here on a column K the current EPS estimate. This is the estimated earnings per share, the average estimate of the analyst in Wall Street, and also we can see here all the fundamentals, all the historical beat and miss rates for both earnings and revenue. For example, if we are going to take Alcoa, Alcoa was expected to deliver earnings of 6 cents per share. As we all know, it delivered only 4 cents per share. Here we are going to see how many data, how many quarters of data we have in our database. Right now, Alcoa has 49 quarters in our database. That means more than 11 or 12 years. That's a lot of data, and for the statistics to make sense, we need at least 20 quarters of data, so the statistics will be meaningful. So no problem with Alcoa on that. EPS bit rate, as you can see, 43% of the time, Alcoa is going to beat the profit line. That means that most of the time it's going to miss, and as we all know right now, Alcoa actually missed the earnings last week. Also, we have here the revenue bit rate. It stands on 59%. So 59% of the time, the stock is actually beating the estimate of the analyst on the revenue line. But by the way, the long-term average for a stock stands on 60%. So 59 is not a good figure. Most of the stock, 60% of the stock on the long run, are going to beat the revenue line. So we have to see at least more than 60 for this data to be positive. So as we can see from the fundamental point of view, this is poor statistics. So we should bet ahead of time on Alcoa to the short side. Now, if we get to the other side of this Excel, we can see this engine includes the stock's average price change on its past reports. So you can see actually whether a stock typically gains or declines when it releases the numbers. So for example, as we can see, Alcoa usually gap up by 0.19% to the upside, but open to close, it's going from the open to the close more than 1% down, actually 1.35% down. That means it's going to end the day 1.19% down. It's going to end the week 1.78% down. So actually, if you have this engine in front of you, you could actually bet a short on Alcoa ahead of time, because you know that on average, on its earnings, it's going to miss, and the stock is going to go lower more than 1%. In the day of Alcoa, it actually went down more than 7%. So actually, you're going to have here thousands, over thousands of stocks. This spreadsheet is sorted by stock from A to Z. And actually, you can type here any stock you want, for example, Apple, and on the spot, you'll get the date of the earnings, the time, PM or AM, and what is the estimate. If you click on the downside on the other notebook, earnings reported by date, and actually I believe this is much easier to use this engine on this sort. This right now this calendar is sorted by date, so you can actually go day by day and to see what stocks are going to post the earnings on the 16th today. For example, Intel is going to publish its earnings PM. That means today after the market. We have 49 quarters in our engine. 69% of the time it's going to beat the profit line. 73% of the time it's going to beat the analyst estimates on the revenue line. And usually, just let's freeze the pane here, so it will be much easier for us to use it, right? Freeze. Here, I just want to freeze. Just freeze the pane. No. This. Just want us to see. All right. Just want us to see the titles. So back to Intel. Let's find Intel today. So Intel today, it has good fundamentals. Usually, it's going to beat the figures of the analysts. From open to close, it's going down by 0.67%. So this figure actually makes sense for tomorrow, because it's going to post its earnings after the bell. That means it's going to react after the bell in the post market, and the stock actually is going to react. The first reaction will be tomorrow in the regular session. So in the regular session tomorrow, Intel is going, on average, is going down, and you, as day traders, we can try to find a spot to short it, maybe a setup for short, because we have these statistics. Actually, we have a card that we know that other market players doesn't know, and this is what gives us an advantage. The engine is an awesome tool that its cost in Wall Street is measured by thousands of dollars. We are happy to share it with you, complimentary, as you are our valuable traders and we want you to make money. We are going to make everything we can in order to push you to the profit zone. Your homework for next week, because we are going to be here and to meet once again next week on Thursday, your mission will be to download this engine to your computer and to review it. In the second part of the lesson next week, I'm going to show you a couple of practical techniques and examples, and believe me, you are going to love it. We are going to take an in-depth look into this engine. I'm also going to share with you 6 screens that we actually assembled from this great and awesome engine. All right, so this is our lesson for today, and of course, once again, just click on the documents and take the TradeNet's fourth quarter earnings engine, download it from there, or just click right now on the link in the chat, and you can download it for your usage. And if there is any questions, I'll be happy to answer them right now. And I'll just scroll back to see if there are any questions, and I believe there are a couple. All right, so if I start to refer to Russell, I start from Russell, and Russell is asking, are we buying in the pre-market? So no, Russell, I'm not taking any position in the pre-market or in the post-market. All the positions, all the buying and selling I'm doing is in the regular session. So if, for example, I want to go, let's take, for example, CMA. Let's take, for example, GE, all right, General Electric. No, General Electric is not good. All right. Let's take Morgan Stanley, all right? So let's take Morgan Stanley. Morgan Stanley is going to deliver its earnings on the 17th. That means tomorrow, AM, tomorrow before the bell. All right, this is a very, very relevant stock for us. Morgan Stanley, AM, tomorrow. Now, just a look on the beat and miss rates. It has good figures here, 70% EPS beat rate. That's good. The average, the long time average stands on 63%. So any figure above 63% is considered to be a good figure. Usually, it's gapping up on the day of the earnings by 0.75%. This is the average, because there are earnings periods where Morgan Stanley, of course, is gapping down, and there are very positive earnings that is going to push Morgan Stanley much higher than 1% or 2%, maybe even 5%. So on average, it's 0.75 when we are taking into account all the earnings, all the up and downs. So what you would like to consider right now, and this is exactly what I'm going to talk next week, is to buy Morgan Stanley today before the end of the session. All right, a couple of minutes before the end of the session, because you want to bet on a surprise in Morgan Stanley and on a gap up. Now, if you are a day trader, then you are going, and you don't want to hold the stock overnight, you are going to watch this column, S column, open to close. What the movement of the stock actually going to be inside the day, in the day trading frame. And as we can see, it has a tendency to go up, almost 1/3% up. That means you should be bullish on Morgan Stanley, and maybe to buy it on the open, or maybe to trying to spot a long setup in the day to actually capitalize on this movement. All right, so hopefully this is answering your question. By the way, if you like this lesson and if you want to get more of this stuff, I'll be happy to hear it. Just write it down for me, or just email me shlomo@tradenet.co.uk, so we know you like it. We know you want to have more things like this. And let's see more questions right now. Antonio is asking, Shlomo, are you talking only about earnings? What about guidance or revenues if they are against the earnings? Usually this info are also disclosed together and might be in different directions. So Antonio, you are absolutely right. You are absolutely right. And as you will be able to see, this engine also contains raised guidance. So what is the percents of time that the management actually is raising the guidance, because this have a lot of influence on the movement of the stock. And actually one of the screen I'm going to show you, I'm going to share with you next week will be exactly this, the best stocks with the best management that are usually raising guidance, and this alone can serve as a very, very positive momentum for the stock. Let's move on. Mike from Maine is asking, Shlomo, does it ever happen that the next day after good earnings, stock went down? So absolutely, Mike. Stocks can also go down, and the reason is because we have lower guidance. So stocks are taking a lot of clues on their direction from the guidance. So if there are very good earnings but the guidance is poor, probably the stock is going to go. Probably the stock is going to go down, and we are going to talk about it next week. All right, guys. If there is any question I didn't answer, please use my email shlomo@training.co.uk. I will be more than happy to discuss it with you. I'm also going to be here next week to share with you a couple of more screens to get a deep understanding how to use these earnings. Actually, we are using these earnings for more than 5 years, very successfully. It's not a thing you are going to fully understand on the first day. All right, so this is why I want you to download it, to use it a little bit, to review it on your own, and then we are going to go on the next level next week. Thank you very much for being here with me. Hopefully this is a useful information, and I'll see you next week on Thursday for the second part of this webinar. Thank you very much, all of you.